I'm now joined by my colleague, Karen Manczko.
Hello, everyone. On this segment, Joe and I will be talking about the attribution of the Wespath funds. To start things off, it's good to set the backdrop. Entering 2025, the U.S. economy was on solid ground with positive momentum. This was quickly soured by the threat of tariffs, which created an equity market correction, along with weakening economic data, which made investors fear of a looming recession and possible resurgence of inflation.
All right, so let's get to it. In another webinar segment, Hua, Director of Public Markets, discussed how the Magnificent Seven, which had been market leaders for years now, experienced a sharp sell-off. Some of that was due to the DeepSeek story we talked about. Our U.S. equity fund is underweight the Magnificent Seven. So Karen, how did the U.S. equity fund perform?
You're absolutely right, Joe. The Magnificent Seven stock underperformance was a positive contributor to the U.S. equity fund, as mega cap stocks were down over 15% for the quarter, which was one of the worst quarters on record for those stocks.
And how did active strategies in the U.S. equity fund hold up in this difficult and volatile equity market environment?
The performance of our active strategies were mixed. Some of the names that our active strategies invested in were negatively impacted by the tariffs and the AI sell-off. But the good news is that our U.S. equity fund composite outperformed its benchmark net of all fees by 27 basis points for the quarter.
All right, so let's touch on international markets. International equities performed much differently than U.S. equities during the quarter. So tell us a little bit about that and the impact that it had on our international equity fund.
It was a much different quarter for international than U.S., which provided a nice, quite different change. International markets had a strong quarter and ended in positive territory, with developed international equities up almost 7% and emerging markets up 1.7%. This surge in international stocks versus the U.S. was the widest margin since the 1990s. As you and Wam mentioned, there were some weak expectations with international markets, which led to depressed valuations, which really created this nice rebound that we saw. The main drivers for the strong international markets for the quarter were weakness in U.S. equities and investors seeking opportunities elsewhere, European equities having their strongest performance since the mid-1980s, and the U.S. dollar depreciation.
Thanks for that rundown on international markets. So based on what you just shared, it looks like the International Equity Fund Composite is up roughly 3.3%, but underperformed this benchmark due to stock selection by the fund's active managers. So Karen, is there anything you want to highlight from our active strategies that caused that underperformance?
We actually saw the fund's ethical exclusions, which are the securities we do not invest in due to their core business revenue, detracted in the International Equity Fund. Defense and aerospace companies performed well, up 35%. Therefore, not owning these names was a detractor. The fund's allocation to alternatives also detracted, which we know this asset class will have headwinds when we see strong public markets like we did internationally in the first quarter. Similar to the US, some of our active managers were impacted by the tariff noise, and they're waiting in certain countries like China, which had strong performance in the quarter.
Great. Thanks for that, Karen. Now let's switch gears and move to fixed income. We saw that the equity markets had a pretty volatile quarter with a wide margin of returns between U.S. and international markets. How did fixed income and fixed income markets perform?
To set the stage for bonds, let's briefly highlight what happened in the bond market. During the quarter, we saw U.S. Treasury yields decrease across much of the curve, specifically in the belly, which, when yields decrease, this is positive for bonds. The Fed left rates unchanged, and inflation numbers in February slightly ticked up for the PCE, which is the Fed's preferred measure. With all of this in the backdrop, we saw Treasuries outperform credit, emerging market bonds outperformed developed market bonds, and investment grade outperformed high yield. With this said, the fund's overweight to high yield detracted, but issue selective by our active managers offset this. Therefore, the fixed income fund composite landed in positive territory for the quarter, up 2.5% and returning relatively in line with its benchmark.
And how did the Inflation Protection Fund perform?
The Inflation Protection Fund composite also ended the quarter in positive territory, but underperformed its benchmark. The fund has a 10% allocation to commodities, which helped its absolute performance since commodities outperformed most bond asset classes. But the fund's underweight to U.S. Treasury inflation-protected securities and overweight to global inflation-linked bonds and senior secured loans detracted. Before we sign off, I know in our webinars we primarily highlight the funds that we just showcased. But late last year, we launched the Social Values Choice suite of funds for institutional investors. We shared some details about that in our last webinar in the fourth quarter. And I thought perhaps we'd highlight those funds a bit for our viewers today.
Great idea, Karen. Our Social Voices Equity Fund is a global equity portfolio. It's passively managed by a firm located in both Philadelphia and North Carolina called Exponents. We have a video of the founder of this firm and our CIO, Johara, on our website. This is a great fund because it allows investors that would like a global equity indexed portfolio wrapped into one fund. It includes the same ethical exclusions as all of our funds, plus has a heightened focus on the environment and human rights. Notably, it's an ex-fossil fuels fund, so it does not invest in oil and gas companies.
We also have a social vice choice bond fund that is actively managed that has the same exclusions that we just highlighted. These funds allow our investors to create a balanced portfolio solution.
And last but not least, we want to remind our investors that we have a U.S. equity index fund that is managed to the Russell 3000, which is another fund option for our investors.
Thanks for mentioning that, Joe. We always emphasize our 4 core actively managed funds, but I think it's a helpful reminder that you have even more funds that can help be the building blocks of our client success. This concludes our prepared remarks, but before we go, it's important for our investors to remember the basics during times like this. As our CIO mentioned in a recent letter to our investors, maintaining a disciplined, long-term focus has always been and will continue to be an integral part of our investment process. This process is firmly grounded in policies and procedures that we are sticking to.
On behalf of everybody at Wespath, thank you for your partnership and thank you for tuning in.